Welcome to this explainer. Let's be real for a second. If you've been trading for any length of time, you've probably realized that trying to catch every single market reversal is just exhausting. Constantly trying to pick the absolute top or the exact bottom, yeah, that is quite frankly the fastest way to drain your account. The undeniable truth of the financial markets is that the trending market is where the real, life-changing money is actually made. And since you likely prefer simple price action, smart money concepts, trend lines, and Fibonacci, the approach we're unpacking today is going to fit your trading style perfectly. Today, we're breaking down the exact playbook professional traders use to identify trends, follow momentum, enter safely without getting chopped up, and ride those moves patiently.
Before you even think about executing a trade or drawing a single trend line on your chart, we have to start with one ultimate anchor question. Ask yourself, who controls the market right now? Is it the buyers? Is it the sellers, or is it nobody at all? If you look at a chart and you cannot answer this question confidently within 5 seconds, well, you shouldn't be clicking any buttons. Understanding exactly who is in the driver's seat dictates literally everything else we do.
To get to that confident answer, here is the playbook we're following today. First, who controls the market? Then, the anatomy of an uptrend, decoding the downtrend, avoiding sideways trap markets, smart entries and price action, and finally, the profitable trader's mindset.
Let's start with Section 1, who controls the market? This is the absolute foundation of our chart analysis.
Listen, market structure isn't some magical predictive tool, and it's definitely not a crystal ball. It's simply the ongoing, observable footprint of buyers and sellers battling for dominance. By reading these historical footprints on the chart, we can see exactly where the institutional smart money is flowing. The goal here is a total mindset shift. We're shifting entirely away from blindly guessing what price might do next based on some gut hunch, and instead we are strictly observing who actually has control in the present moment. Institutions leave massive footprints. Our job is literally just to follow them.
It really boils down to a binary battle. On one side, we have an uptrend, where buyers are clearly in control, looking to push the price to higher highs. On the flip side, we have a downtrend, where sellers are in absolute control, pushing for lower lows. The golden rule of trading, before you add moving averages, before you even pull a Fibonacci retracement, is that we only ever want to trade in the direction of this dominant force. Think of it like swimming in a fast-moving river. You want to swim with the current, not exhaust yourself and drown trying to fight against it, right?
Moving on to Section 2, let's examine the specific rules that make up the anatomy of an uptrend and how to ride that bullish momentum.
When we're looking at a bullish market, the structure is incredibly specific. An uptrend creates distinct higher highs and higher lows. Each time the market pulls back, it establishes a low that is fundamentally higher than the previous one. And why does this happen? Because buyers are eager. They're stepping in earlier and with way more aggression, completely willing to pay a higher premium because they believe the price is going much higher. This confirms buyers are firmly in control. This is exactly where you want to draw your ascending trend lines or pull your fibs from swing low to swing high. Your singular option in this specific environment is to look for buy setups only. Do not, I repeat, do not try to short a market that is consistently making higher highs. Just follow that momentum.
Now let's look at the exact opposite scenario in Section 3, decoding the downtrend to capitalize on bearish momentum.
Just as we saw with the buyers, when sellers take absolute control, they leave a very clear footprint, lower highs and lower lows. Every single time the market tries to rally and catch its breath, the sellers slam it right back down at a lower price point than before. Supply is just completely overwhelming demand here. I mean, how many times have you tried to buy a dip only to realize you were basically catching a falling knife in a downtrend? When this structure of lower highs and lower lows is active, your action is simple. Exclusively seek sell setups. You pull your fibs from the swing high down to the swing low, and you capitalize on that bearish momentum.
But what happens when neither side is winning? That brings us to Section 4, and arguably the most crucial part of this entire analysis, avoiding sideways trap markets, also known as the place where amateur retail accounts go to die.
You seriously need to treat this as a massive danger sign. When the market stops trending, it enters consolidation. And if you're trading smart money concepts, you already know the true nature of consolidation. Sideways markets are often just institutional traps. Smart money uses these tightly bound zones to build their positions and sweep liquidity, violently grabbing the stop losses of early buyers and early sellers alike. They are purposely chopping up impatient retail accounts who are desperately trying to force a trade on a random Tuesday afternoon when no clear trend even exists.
So how do you actually know you're stuck in one of these traps? Well, there are no clear higher highs or lower lows. Instead, price just bounces erratically between a tight support floor and a resistance ceiling.
Nobody is in clear control. When you ask yourself that anchor question we started with, who controls the market right now? And the answer is nobody. Your absolute only action is to stay out. Cash is a position. Sitting on your hands, protecting your mental capital, and preserving your account balance is a highly profitable action in a sideways market. Don't become the liquidity.
Okay, so you've identified a clear trend and you've successfully avoided the sideways chop. Section 5 is all about smart entries and price action, and executing with precision.
See, identifying the trend is really just step one. Now we execute the precise entry playbook. First, obviously, identify the trend structure. Second, wait for the price to pull back to your point of interest. This could be a key supplier demand zone, an order block, or maybe a golden Fibonacci pocket. Now, step 3 is absolutely crucial for SMC traders. Let the early retail traders get trapped. You want to see the smart money sweep that liquidity and take out the obvious stop losses resting just above or below those zones. And finally, step 4, wait for clear price action confirmation to enter. Don't just set a limit order and pray. Look for a strong candlestick rejection or a structural shift on a lower time frame.
You really need to internalize this mantra. Professional traders do not catch falling knives. They don't try to blindly guess where the exact top or bottom of a pullback will be because they know the market can always go lower or higher than they think. They wait for the trap to play out. They wait for the shift in momentum to explicitly prove itself to them, and then, only then, they safely ride the established trend. Confirmation is your ultimate armor in this game.
But here is the stark reality. Having the perfect SMC entry playbook means absolutely nothing if you don't have the discipline to execute it. That brings us to Section 6, the profitable trader's mindset.
Listen to this quote really closely. The edge isn't in the tool, it's in the trader. You can have the best indicators in the world. You can know literally everything there is to know about market structure, liquidity sweeps, Fibonacci retracements, and pure price action. But all of that sophisticated technical knowledge is completely useless if you lack emotional control. You are the ultimate deciding factor in your long-term success.
Becoming a consistently profitable trader requires this continuous and sometimes painful loop of self-mastery. You learn the system and you apply the rules. But inevitably, a perfectly good trade will go against you. That is when you must observe your emotions. Do you panic? Do you immediately revenge trade with double the lot size? Do you widen your stop loss? You have to take that psychological data, adjust your mindset, and actively strengthen your inner discipline. Trading is basically a mirror reflecting your own flaws back at you. If you don't fix the trader, no strategy is ever going to save you.
Because the harsh reality of the Forex market is staggering, 95%. 95% of traders fail. And honestly, they don't fail because they aren't smart enough to know what a higher high is. They fail because they constantly break their own rules. They get bored and force trades in sideways trap markets because they just need a dopamine hit. They enter way too early because of FOMO and get caught in the liquidity sweeps without waiting for confirmation. They systematically let their impulses override their logic.
So I'm going to leave you with this final, provocative thought to take away from today's explainer. Look at your charts, analyze your last 10 trades, and ask yourself honestly, are you trading the market structure, or are you just trading your own emotions? Master yourself, wait for the clear trend, execute only with confirmation, and you'll finally find yourself on the winning side of the market.